guys, well, let's go ahead and get started. There's probably going to be quite a few people that are signing on throughout the presentation and stuff here. We are live on Facebook, and so I want to be respectful of everybody's time. So first of all, I want to say thank you and welcome to an introduction to mortgage loan investing and non-performing loans. My name is Larry White, and I am the current default chair, the current chair for the default committee here at AREAA. And I want to introduce a couple of guests, but before that, let me just go through a couple of housekeeping items, guys. Gary, if I could just share my screen here real quick, that would be perfect. Thank you so much. So I just want to do a couple of housekeeping items. If any of our guests that are here and listening with us, go ahead and type chats. If you're watching this on Facebook Live, want this to be as interactive as possible so that everybody gets the most out of it. So if you're on Facebook Live, go ahead and type in some questions there and we'll relay it back to Kevin and Ernie here. If you guys are on the actual webinar and stuff with us, then make sure that you guys are go ahead and interacting in the chat box. But as the default chair and an active member of AREAA, I just wanted to remind everybody that this October 20th through the 22nd, we have our 2022 National Conference. This is AREAA Unplugged. If you have never been to an AREAA National Conference, it is packed with all sorts of different topics coming in from not just across the country, but across the world. We talk a lot about different global events, what the market is doing, and how can we add value to our members to be able to help position them for the future cycles that are coming along. So if you guys are somewhere where it is not beautiful, it is a great reason to get away. This is October 20th through October 22nd. It will be at the Manchester Grand Hyatt in San Diego, California. You can register at area.org/convention, and we will drop that link into the chat box as well, so everybody has access to that. So if you've never been, it is just a wonderful community of top producing real estate professionals, all there trying to add value to each other. So wanted to get that out, make sure that you guys are interactive if you guys have questions or anything like that. And as we get started here, I'll first start off. I'm super thrilled. Ernie Armijo is actually sits on the National Default Board of AREAA with me here, and he is a wealth of knowledge to real estate agents across the country. He's a former fund investor himself, a non-performing notes buyer. He has 20+ years of investing experience, fix and flip, and working with different hedge funds. In his past life, he was actually the managing broker of Berkshire Hathaway with over 1,600 agents himself. And now in his current state, he's a team leader with over 200 agents that he is looking to help them increase production, decrease costs, and build wealth. So Ernie, thank you so much for moderating this panel and kind of putting this together, because from what we can see from the registration, this is a topic that people are interested in and they want to know more about. So thank you for putting this together, my brother.
Thank you, brother. Appreciate it.
Absolutely. And then our guest here for today, I'm super excited about, right? So we have Kevin Shortall here, and he's been in real estate since 1985. Right, and he started as a
quick math on that. Yeah,
right. Everybody's like, oh man, he's really old. No, he's not that old, right? 40 is the new 20 at this point in time, or maybe that's just what we say as we start getting older here, right? But he started as a commercial appraiser, and through the use of partners, mentors, he was involved in both the real estate side of things, the paper side of things, and the real estate investing side of things. So he has a drastic amount of experience personally, having rehabbed and resold over 150 different properties himself, and transacted over $30 million in private notes. And so he comes as an expert in this non-performing notes part of the world that we're sitting here talking about and educating today. On top of that, like to prove some of his credibility and stuff here, he's also participated in a number of media segments where he's been the featured guest and co-hosted American Success Stories with Robin Leach. He's been on CBS, NBC, ABC. He's a published author, an accomplished author, professional speaker, and podcaster. So Kevin, thank you so much for taking the time out of your day, coming and sharing some knowledge and stuff here with AREAA. I'm going to go ahead and back away and let the two of you guys kind of run the show and get things going. I appreciate both of you guys being here, and thank you.
Great. Thank you, Larry. It's an honor. Thank you so much for the kind words. Hi, everyone. This is Ernie Armijo and Kevin. Today, Kevin's going to be doing a presentation on introductory to investing in notes and investing in non-performing loans. I've had the fortunate privilege of being able to work the system with them and buy notes and be able to run them through the system. Some we were able to do workouts, others we unfortunately foreclosed and renovated and put it back on the market and sold. This was a national play. I definitely love this play. Back in 2008, there was a lot of lenders selling off notes for 21 cents on the dollar. I wasn't in that space at that time. Years after that, when I met all of the huge hedge funds that had purchased in that manner, I decided to get educated and be able to play in that space. And so fortunately, for the past 10 years, I've been playing in that space, and it's been a lot of fun. It's definitely a good entry point to be able to go in and have minimum monies to invest. There are monthly costs and all that kind of stuff, but it's definitely a fun place to play. With that, I am privileged to say, hey, here's Mr. Kevin, and I can't wait to see the presentation.
Hey, thanks, Ernie, and thanks, Larry, and thank you everyone for attending. I appreciate it. I'm looking forward to this. I've got my stand-up desk here ready to go. So I put a lot of information together for you. I do want to make sure that I maximize your time within this. So I believe they've already said, but just as a reminder, if you have questions as we go through, go ahead and pop them in the the Q&A, and that way they'll get the questions, and I'll be able to get those as we go through. Otherwise, I'm going to go on a pretty quick pace here with you today. I am making an assumption that you have some real estate exposure, but I'm not going to make the assumption that you have exposure to the notes. So I'm going to start by going over just some of the basics to get everybody's mindset properly, and then we'll talk about some of the best opportunities within this segment of real estate. And by the way, this segment of real estate, being the note side of the business, is really just the financial side of real estate. And I think once people understand that, they'll think the same way I do, which is, I don't think you're a complete real estate investor until you know both sides of it, the real property side, which many of you do know, combining that with the financial side, which is what the note business is all about. So I'm going to go ahead and share my screen here with you. Get this set up, and just to double check, you all can see my screen. Is that correct? Ernie or Larry, you guys can see my screen.
Yep.
Okay, great.
Like,
yeah, just
like
checking.
I
want to make sure before I get too far down the road here, everybody's like, we can't see what you're doing there. So as Larry mentioned, I've been in this space for quite some time, over 30 years in this, and teaching it for well over 25 years. I really enjoy teaching that. I hope that comes through today as well. Written books on this topic. And what I've done is I've taken some of the best things that I fit what you all are looking for in this particular segment here, and also addressing some of the issues that we all are experiencing right now. And I'm not going to belabor these issues. I am doing a podcast on a special focus on these things and how it affects real estate and real estate notes, but it certainly has to be on everybody's mind. We've all seen the cost of goods and services go up. We've seen the effects of inflation already at 40-year highs, possibly already in a recession. Perhaps recession is coming. The experts are still weighing all of those things out. And it does have an overall effect on us as investors. And if you really examine the note business, which I hope you do, and I hope I'm the catalyst that gets you to think about this, This is amongst, if not the best investment in this environment that you will ever see. The opportunities, the safety, the returns that we get, there's a big dynamic difference here between more traditional real estate, the so-called brick and mortar, and the paper side or note side of that business. I'm going to bring that out to you today. So for example, home prices, we have people, I saw as you were chatting in there, we have people from the East Coast, the West Coast, and every place in between. And home prices are always localized, but in general, national numbers and statistics will show that they are starting to plateau. In some areas, already starting to go down a little bit. In the note space, we can control what risk factor that we take on any particular deal, and that insulates us a lot from home prices. I would say all of the personal clients that I work with right now, if we had a 20% drop in real estate prices, they wouldn't miss a beat. They would not be affected by these investments. Next one, interest rates. Interest rates are going up across the board. That also means that lending rates are going up. Lending rates are at the point now where many of you being real estate agents and such, you're starting to see people back out of sales. I've talked to a lot of agents across the country where that's starting to happen. The buyers are starting to dry up a little bit as they look at the affordability because of the higher interest rates. A couple of minor things that I always look at over the years is I have this concept here that I've developed over time of when are people going to start to default on their loans, on their mortgages, on their rent. And normally when it comes to loans, the notes that we buy, there's a period of time where people have to prioritize their bills. If things go wrong financially or get more expensive, normally the unsecured debt, the credit cards are the first things that start to go unpaid. And what we've seen, if you look at the numbers, the amount of use of credit cards, which was relatively had gone down for a number of years, went up pretty drastically. And now the default rate is going up pretty drastically. That's an indicator of things to come. The next thing is usually automobile loans. Well, I looked at it the other day. There was an article, I think it came out from Forbes. I could be wrong on that, might have been Fortune, but they've seen, especially in the people who've bought cars over the last 2 years, the default rates have gone up quite a bit. And that's normally, again, the order that people do things in. The next in line is the rent. The next in line is the loans and everything else. That's why for most note investors who want to be safe, who want to be active, who want to diversify, who want to get the highest returns with the most safety, focus on the affordability range. And that means a lot of you who might be in the higher end areas of California or out in New York, you may not be investing in these assets in your own backyard. You'll go to where the best opportunities are, and that's in the affordable housing arena. Now, across the nation, that's about $150,000 homes and less. And again, I know I'm addressing people out in Hawaii, California, New York, Boston, and everything else where you're going, 150 doesn't buy anything. I realize that. That's why most of my clients will go to where the best deals are, because they've got safety, they've got demand, they've got insulation from risk, diversification, and a lot better opportunities, which I'm going to show you today. Seller financing is on a huge uptick once again, because seller financing historically has always filled the void when there is something that has changed in the traditional mortgage market. Well, has something changed in the traditional mortgage market? Yes, rates have gone up pretty drastically, right? So what happens is in the affordability type of prices and price ranges, $100,000 homes and things like that, which are nice 3-bedroom, 2-bath, working class homes in large swaths of the country here, seller financing is picking up. The people are selling homes with financing. Investors are buying homes. They're turning around, fixing them up and selling them with seller financing. And that's been a great amount of inventory that's been coming from companies such as that. They've learned, and I've had a lot to do with that, how to create seller finance notes the right way, creating a note of value, not just a note to solve a problem of selling a property. So we're seeing a lot of growth in that area on both sides. Real estate investors applying it, knowing that they can create a loan and turn around and sell it. And investors on the note side looking to build relationships with those investors to buy those notes. The delinquency rate interestingly enough, has been fluctuating over time. Now, a lot of the delinquency rates were paused a little bit. You all might recall when they put in the forbearances, right? So anybody that had a federally backed loan, not a private loan, by the way, federally backed loan, they were able to file for a forbearance plan, which means no payment. It started for 3 months, and then it became 6, and then 12, then 18, and ultimately 24. We still have about 2 million borrowers that are just coming out of those plans, not all of which are going to be able to afford those payments. Now, with all these issues, of course, comes opportunities. We're really coming up, if things go just how they are right now, inflation gets tamed a little bit and we don't get into a recession, we still have one of the best investments, if not the best, in this environment. If it gets worse, no question in my mind, we have the best opportunity in the note side of the real estate business. And as a result, you're going to see income opportunities and you're going to see wealth creation. And what you will find is that cash flow, okay, passive monthly cash flow is more predictable than appreciation or depreciation rates. And you'll see that as a direct result of this. I've been studying this a long time, and I've seen the note business grow from a niche in investing to its own asset class. And that's been really interesting to see over the years. In fact, many of you, I'm sure, like, I don't know how many books he sold, but Robert Kiyosaki, Rich Dad, Poor Dad, when that came out, myself, like a lot of people, read that book. And there were some things in there that were controversial. There were some other things. What I noticed, because I've been investing in the note space, was he talked about real estate, but never the note side of the business in the first book. That has dramatically changed. And I think someone from a high profile like him, to see them go from not mentioning notes to now saying that should be a part of everybody's portfolio is a pretty dramatic change. So this industry has really grown in reputation, technology along with that, opportunities along with that. And well, in fact, one of the last quotes from Robert that I read says this: to obtain financial freedom, one must either be a business owner, an investor, or both, generating passive income, particularly on a monthly basis. That is almost the definition of a note investor. They're in the note investing business. They're investing in these assets, and these assets generate passive income on a monthly basis. So the very definition that he is using for financial freedom is within this asset class. Now, you'll never hear me say that notes is the only thing you should ever do. And there are some people in the note business that's what they say. I'm not a subscriber to that, because there's a lot of money to be made in traditional real estate. What I am saying is the combination of both of those things is the key to any kind of economic environment. And it will grant you the greatest opportunities because you've got the investment side on the real property combined with the flexibility and the creativity of the financial side of the business. In fact, in his last book here, you can see very clearly my point. Very simply, the rich invest their money in assets that put more money in their pockets, such as real estate, stocks, bonds, notes, and intellectual property. So notes has been elevated to its own asset class to the point where it really should be a part of everybody's portfolio. So what the heck is a note, and how is this different than traditional real estate? Let's break it down for those who are not familiar with this. If you're a little familiar with notes, just kind of have some patience with me. Let me get those other ones who are not, they're just being exposed to this. Let me get them up to speed here. So investing in real estate backed notes, that's really what we do. We invest in real estate backed notes. So all of the notes that we buy are backed by property, real property. It could be a single family home. It could be vacant land. It could be a commercial property. It could be acreage. It could be any asset that is real property. Okay. That is our collateral. We don't own the collateral in our business. Okay. We don't own that single family home on your screen there if we're in the note business. What we own is the note and the mortgage on that. So when this person bought this home, they borrowed money. to when they borrowed money, they had to promise to pay it back. And that promise to pay it back has to be in writing. And that is really what a note is. A note very simply identifies the property, who's borrowing the money, how much are they borrowing, what's the interest rate, what's the payback period, when are the payments due, when are the payments late, what are the penalties, where do I send them, all of the information about the note. And that's what they start to pay. Now, if they're borrowing this money from you or from a bank, because in this business, you are the bank, if they're borrowing this money from a bank's going to say, great, we have your written promise, we have your promissory note, but that's not good enough, because what if something happens and you break that promise? Sure, we have some legal issues here, but we want you to put something up as collateral. That's what the mortgage does. That's what the deed of trust does. Okay, so the security agreement, in this case on your screen, a mortgage, that's all it is. It's a security agreement. The mortgage essentially says, if I, the borrower, do not pay you back according to the note, you can enforce the mortgage. And what the mortgage says is you have, as the borrower, you have the right to foreclose on this property if I don't pay according to the agreement. That's really it. So we buy the paper. Now, everybody calls it the note business, but we never just buy a note. We buy a secured note. Okay, so the note is secured by this mortgage agreement. The mortgage agreement is the one that attaches it to the property. Okay, that's why the property simply becomes, for us, the collateral. If they don't pay, then we can go after the collateral. Okay, now obviously we can modify a loan, we can do forbearances, we can try to work with people, but worst case scenario, at the end of the day, our investment is backed by that property. So if we know what that property is worth, and I'm sure most everybody, if not everybody on this Zoom right now, is familiar with valuing real estate. Okay, that's a part of this business because that's our collateral. Then by measure, how much am I investing in the secured paper on this property? That's how I manage my risk. So for example, if they only owe $30,000 on this note and mortgage and I'm buying that, but the house is worth $100,000, again, I'm just using simple numbers. They could be any numbers, just simple we can do in our head. Do I have a huge risk there? And the answer is no, because that property could drop, like I said, even down to $80,000. I'm only in this thing for less than 30,000 bucks. Okay, so that's where our security starts to come into this play here. So let me give you a little illustration on how this works. We're the note owner. Okay, so we're a note investor. So if we buy the paper on that property, we're a note owner or note investor. What we are buying is the cash flow that's generated from that loan. So if this loan, might be able to see it on the bottom here, and I'll just use that as a screenshot example. The monthly payment on this one is $443.32. So if we buy that loan, we are now the bank, we're now the note owner, and we're collecting that $433 every single month. But we're collecting it like a bank collects it. We are not a landlord. So we don't have the landlord liabilities or responsibilities. They're not tenants, they own the property. We don't have to manage that. They don't call us with the toilet overflowing, the roof leaking. They own the house. Much like if you have a loan with Wells Fargo or Bank of America and you have a roof, you're not calling Bank of America, hey, you got to send somebody over, the roof is leaking. Okay, you don't call the bank. That's who we are. The note owner is the bank. So we don't have all of those issues. And as a bank, we are allowed to invest with our own money, or you might want to do it through tax sheltered accounts, self-directed IRAs and 401ks. All of those entities are allowed to invest in these assets. And it's a lot of hands-off and passive income because we do have a servicing company in between. So the servicing company will send a letter if the payment is late. They'll make a phone call if the payment is late. They'll send a demand letter if the payment is late. In the meantime, the money comes to the servicing company. The servicing company takes about $15 of that, and they pass the rest of the money on to you, wired right into your account. If it's being escrowed, they hold the escrow. They make sure the taxes and insurance are paid. You don't have to do a thing on that. In fact, all the servicing companies today, you can log right in online. You can look up your account and see all the payments that came in. If it's running late, you can see conversations, the whole thing. So it can be very, very passive on one hand, but also can be a little bit active depending if you're buying a performing or non-performing note. Okay. And that's the next point here. Generally, mortgages and notes, okay, real estate backed notes fall into two categories. They're either performing or there's some kind of non-performing. Okay. We have a non-performing category and a sub-performing category. Okay. Non-performing, they haven't made a payment in 6 months or so. Okay, there's no hard definition of that. A sub-performing might be they made this month's payment, they missed the next 2 months, then they made a catch-up payment on the following month. So it just kind of depends on what that is performing. I think all of you would agree that right now we are going to be facing a time, because it's already happening right now, where there's going to be more and more of these at least sub-performing notes. I think all of you would have to agree with that. Again, if we go back and think in terms of interest rates and hours being cut and people working less and getting back to this, in some places you still have the COVID issues are restricted more than other places. So there's this uncertainty for people. The mindsets are things are getting worse, and so a lot of people are running into problems. Again, the credit card debt, the not making car payments, those sorts of things are indicators that there's a bigger problem looming out there. So it's logical to think that we're going to see more of these. Our inventory levels have actually increased in this area because some of those loans that were given the forbearance plans where they didn't have to make a payment, well, guess what? The plan's over and they're still not making a payment. What the banks will do is bundle those things up and sell them. Okay, and there's a whole trickle down on how that happens, but that would deflect us a little bit here. So we know there's an impending problem. It's already starting to happen right now. So what the government did about 6 months ago, maybe a little bit more, and it's something I've been tracking because I knew it was coming. I research this on a daily basis. This is what I do for my life, if you will, for my living. And I knew a program was going to come around because the government has identified that problem as well. I even researched the economic advisor, Jacob Bernstein, for the Biden administration, and he was a big proponent. He did a presentation, by the way, if you guys want to look it up. I heard him talk about real estate agents. So if you're part of the National Association of Realtors, you can look up this presentation. I think he did it maybe a year or two ago for the National Association and Bernstein. And he talked about programs and how to help people. And he's huge on affordable housing. We need more affordable housing. Those are all indicators, everybody, that the government is going to be promoting this space. And that's why I position myself and my clients to work this out. So about 6 months ago or so, they started this new plan, rolled it out to all the states, and they said, you have to apply. Here's what we're going to do. And they put aside almost $10 billion on what they're calling a homeowner assistance fund. And you can see this is a snapshot directly from the U.S. Department of Treasury. That's where the money is coming from, $9.96 billion. And they're going to allocate that, which they've already done, to every single state in the United States. Every state's going to get at least $50 million. So part of it's on population and items such as that. So that money has already been allocated, to every state. So there's a lot to see on that one website. Here's what it breaks down to. $10 billion has already been funded. And they said, hey, every state out there, you come up with your own plan on how to take this money and get it to the people that need help, the people who we don't want them to lose their home. Okay, so all of that's been allocated as a part of this American Rescue Plan Act to help assist borrowers with past due payments. So think about this. If somebody is facing foreclosure because they didn't have the ability to make their payments for whatever reason, Maybe it was COVID related, which a lot of things were, right? The economy essentially, a large part of it shut down, and a lot of people were affected by that. They're unable to make their payments, so they're facing a loan acceleration. Banks are calling the entire amount due, and now they're facing foreclosure. Well, what a lot of people don't realize is banks sell that non-performing paper. When banks start building up non-performing loans, in other words, all these loans, hundreds and hundreds of loans at a time, maybe even thousands at a time that aren't being paid upon, they bundle those up and they sell them to big hedge funds. And eventually those hedge funds keep the higher end stuff and trickle down, guess what? The affordable housing stuff for us, which is perfect. This is where you want to be. So if somebody is facing foreclosure, how can they stop that? It's pretty simple. Pay what you owe. Pay what you owe. You owe $15,000 in missed payments, pay it. It'll stop the foreclosure. Now, of course, the problem is they don't have the $15,000. This does. This program pays that money to the note holder to catch them up on their loan. How about that? And it does even more than that. Let me show you a case study so we can learn from this. You're gonna love this. I'm going to show you in this one how to make big money on a small deal. Okay. All right. So, whoops, pop back on me there. There we go. Little property, Fort Wayne, Indiana. Probably couldn't even pick it out on a map, right? But we know it's in the Midwest. A lot of our inventory in affordable housing, Midwest, Southeast. Now, this property is worth about $40,000 there. Okay, now again, I know there's going to be different reactions. I can't see you, and that's one of the things I miss about a lot live audiences. I can't see you, but I know some of you are like 40,000. You put that house here, it'd be worth. I get it. Okay, so again, Mid-America, good pricing, affordable pricing for houses. So $40,000 on this property. That's what it's worth. Okay, these folks fell behind, got into trouble. In fact, the servicing company here, this is their report. So you can see I've got it circled in red there. They still owe $30,320 on this property. Okay, so that's that's the balance versus a $40,000 property, not much equity. Right? Because in this particular case, property values had gone down. But here's the kicker. They owe in what's called an arrearage, $25,054.39. I'm just going to say $25,000. They owe $25,000 in missed payments because those missed payments start to accrue penalties and interest and everything else. So how are these people going to be able to afford this? If you add those numbers, that's more than what the house is worth. They're in trouble. So they're going, we can't do this. Does it even make sense for us to make payments on this property? This became a serious delinquent loan. Okay, if you were evaluating this with me, I would be pointing this out saying, look, what's their motivation to continue to make payments on this thing? Right? They owe more than the house is worth. So you've got to pay it at a discount. When we buy notes, especially defaulted notes, and that's our topic, this is a defaulted note to the tune of $25,000 here, and that's a heavy default in this case. We buy them at a discount. Okay. Now, this discount is a little dramatic. Okay. But I'm going to show you another case study here, but this is a real deal. This investor paid $8,555 for that delinquent paper. Let that sink in for a minute. This is backed by a $40,000 property. What's the worst case scenario? Get the property back? $8,555? That's what could happen. Our goal as note investors is not to kick people out of their houses and take it from them. We want to do loan modifications. We want to work with people. We want to make this a performing cash flow. It's better for us in the long run. It's better for them in the long run. It's a win-win scenario. Now, by the way, there are cases where there's vacant homes. You can buy non-performing loans on vacant homes, and you can get quitclaim deeds and everything else for those homes. So there is a way within this that you can buy non-performing notes with the purpose of buying discounted real estate. Real estate that's not going to show up in foreclosure sales, you'll get it first. Okay, that's another technique. Okay. But in this case, these people, does it look like they want to move out? Not to me. Okay. It seems to me that they're taking care of the property, even though they're not making the payments on it. Okay. That's what it looks like to me. Right. And we go through paperwork and we investigate all this sort of stuff, but you get the point. So we paid $8,555. This is Larry's deal. Pretty good deal. So now he's in that. So now he's in the workout phase of this. So here's how this deal went down. The note investor, which by the way, never went out to this property, found the note online, did the research online, made the offer online, do the closing online. You're not driving around, that sort of thing. It's all done through the internet. If you need and want somebody to go out and do a BPO, to go out and take pictures of the property, you can do that for about $120, basically anywhere in the United States. So I'm not saying you'll never see the asset, but you certainly would make an offer subject to an acceptable BPO. Okay. So this note investor paid $8,555 to buy the note. Then they had some legal expenses because the borrowers were so severely delinquent in this case that they were just going, well, we're just not going to answer. You know, as far as they're concerned, the servicing company that Larry had contacting them was just another lender. And they have successfully, when you think about it, not made a payment for a couple of years. So they just said, hey, let's just be quiet. Let's not answer, because that's what we did to the last note owner, the bank, and we're still here. Okay. So sometimes you have to wake them up a little bit. So he did, because they didn't contact him back, he did go ahead and initiate a foreclosure process. That woke him up. Okay, so that cost a couple $1,000. So on the tally on the right-hand side, he's in this now out of pocket, if you will, $10,555 for the note purchase and the legal expenses. Now, once the door of communication opened, he told these folks about this program. Go apply. They can help you. They can catch up. It'll get you back to a current on this loan. You'll actually have equity back in your property. So they did. And this was in Tennessee. Oops, not Tennessee. Got the wrong logo up there. Sorry about that. So this was in Indiana. My apologies on that. So they've got back from Indiana $23,640. Where did that number come from? Well, if you remember, they were behind $25,054 during this period of time. And the processing takes about 90 days to get approved. So there's probably several other payments in there that weren't paid. So they paid to the note investor $23,640. The investor only has $10,555 in it. It doesn't matter what the note investor paid. It's what do they owe. So imagine taking your $10,555 investment and expenses and getting within 90 days, $23,640 back. This is what I mean. With this new program, there is no better place to be. They're putting the money together for the people in default because they know that there's a problem. They already have the solution. The problem is with the government programs is the people who need them don't know about them. That's what we do. We buy the note and say, hey, I can send a door knocker anywhere for $75. Look at this program. I can send a FedEx. I could do whatever. Let them know that this program is this. They apply. The money goes directly to us. So this investor, of course, had no money in this at this point in time at all. He's made a profit on this deal already, $13,000 profit in this already. But that's not it, because when they looked at the situation of these borrowers, they said, you know what, we think they're going to need even more help moving forward. So we don't want to set these folks up for failure, pay $23,000 on it, and then have them go back into default. So you know what we're going to do? On top of that, we're going to pay their mortgage payment for the next 15 months directly to the note investor. That's another $5,843 in payments. And guess what? He still owns a note with a $30,320 balance with 106 months of payments still due. This is why we're looking at these subperforming notes. It's already been proven from the past crash in 2008, the government really couldn't help by going direct. The hedge funds that came in couldn't help. The local governments could. It came down to investors like us, and that's where this program came from. The new version of this program just started you're at the very beginning stages of this right now. I mean, most states just got approved within the last 3 to 4 months. It's that new. And when you talk about states that have a couple $100 million worth of money that they have to spend, the money they don't spend goes back to the Treasury. What politician wants to be known as the one that they could have spent another $100 million helping their citizens, but they couldn't get it out to the public, so they sent the money back? I don't think anyone does. This one is a brand new deal. I just spoke with this client this morning, by the way. So we're going to take what you just did. I'm going to go through that part a little faster and then show you yet another way to take these loans to a different stratosphere here. So this note I put out, one of my clients purchased this 2 months ago, something like that. So it's a brand new note. It just by circumstance, I had a one-on-one personal session with him today, and this was one of the things that we talked about again to get a status update. Typical situation. This property was in foreclosure. It was renovated and resold with seller financing. So a real estate investor bought this property out of foreclosure, fixed it up, and sold it with financing, thereby creating a note. Okay, great. The people living in the home are making the payments on the note. They did this under what's called a land contract. It's a type of note in mortgage arrangement. I'll leave it at that. It's a little bit different, but that's not a part of our focus right now. So they did this under a secured note called a land contract. And the documents with that include a quitclaim deed, and assignment of seller's interest, a launch, taxes. We look at all that paperwork ahead of time. Okay, so it's not a mystery here. We look at the paperwork ahead of time so we know exactly what the terms were. Everything is recorded, so we have all of those items. So we reviewed this, and I reviewed it one-on-one with this client when he bought the note on this, all these different documents we go through. Obviously, I blacked out personal information on this, but this is kind of what the notes will look like here. We also looked at the collateral value, right? Because that's our fallback position here. So this property is worth about $80,000. Now, we had the same borrower in this property for quite a long time. And I put a little asterisk there because what had happened in this situation, boyfriend, girlfriend signed on the original loan, boyfriend, girlfriend get into a disagreement and decide to part ways, and the boyfriend wanted off of this loan. Well, the person who owned the note let him off of the loan. I personally wouldn't have done that, but once I found out the story, the boyfriend became such a problem, it was better to let him off of the loan. So he left his girlfriend and 2 kids now to cover this loan. So they went through a bit of a loan modification and that sort of thing. But the payments are once again affordable, $369.74. It's got an unpaid balance of $41,467. Okay, so we got an $80,000 house. She owes $41,000. The payments are reasonable, $369 per month. So that is the note as it was being purchased. Okay, so $41,467, it's secured by the land contract here. There's still 315 payments remaining of that payment amount. The investor who bought that, my client who I talked with this morning, paid $30,000 for that note. So a $30,000 investment backed by an $80,000 house. And because he bought this note at a discount, his return goes up. And in fact, in this case, it went to 14.45%. Now, just in case you missed that and you're new to the business, if you bought this $41,467 unpaid balance, that's the UPB note, for $41,467, your annual yield would be 9.9%. You would be buying it at par, if you will. He didn't buy this at par. He bought this at a discount because it's a defaulted note. It's a subperforming note. He paid $30,000, but he's still getting that same monthly payment. So his return goes up. Her payments don't go up. They stay the same, but because he paid less for those payments, his return is 14.45%. Where else can you get 14.5% annually on your money backed by something that's worth more than twice what you have in it because the property is worth 80 grand? Now, here's the thing. She has an arrearage account. This one's in Michigan. So in Michigan, and this is direct from that Michigan's page there, the Homeowner Financial Assist or the Homeowner Assistant Fund program that I've been talking about, they pay $25,000. And you can see all the different things that it pays for, including land contract payments right there on the second bullet point down there. But it also would catch her up on insurance, property taxes. There's no homeowner association fees here, but even internet broadband services. Okay, so Michigan's thing is we'll grant somebody up to $25,000. Okay, now in this case, the numbers are a little bit different. So the note investor, once again, bought the note for $30,000. No legal cost in this at all right now. So that's a zero. So 30,000 bucks. If she applies and gets this money, so we got the plan, he's got people in motion here, gets the $25,000, he's going to be in this thing for 5,000 bucks. Right? So he's got 30,000 invested. Within 90 days, he gets $25,000 back from Michigan, and he still owns the $41,467,000 note with 315 payments. Okay. But he's only got $5,000 now in this deal because he got $25,000 back. You want to have some fun, go back and look at your numbers again. This is what the numbers looked like just buying it flat out. If this all he ever did with this note, forget about the funds, he's still making 14.5% on this note. Now, though, if I recalculate at 5,000, because that's all he's got left in this deal, he can take that other $25,000, invest in another note, whatever he wants to do. That's an 88.74% return. Small investment, huge returns, because the big growth factor here is this program. Now, I'll tell you this, though, you never buy a note just because of this program, okay? And that's why this deal stood on its own just like this. But boy, you apply this plan here, 88.74%. It doesn't get much better than that. Oh, but wait, it can. Okay. So the longer term phase of this, he invested in this with IRA money, by the way, his children's IRA money with this one, long-term thought on it. So here's the thing. Then this is what I'm coaching him through right now. So you still own this note. Okay, you got all your money back except for $5,000. So that's back in their IRA. The 5 is still in this note, if you will. You still own this note with 315 payments remaining. Okay, now I want you to visualize this. When we buy notes, that's really what you have to think in terms of, is this note represents 315 months into the future with a payment being made every single month. Okay, that involves time value of money. So let me play it out here for you. Visualize it like this. Here's the next payment. And then there's that 315th payment out into the future. And think of it as a timeline there, right? So there's monthly payments here in between. So I put these lines to kind of represent the monthly payments from this. So he owns this note. Here's the next payment. And then here's the 315th payment in the future. When you understand it that way, this new concept of selling a partial is easier to visualize. So let's say he gets that money and he gets the next 3 payments, right? Because it takes about 90 days. He's going to keep those payments. Then in the meantime, what he's doing is going to sell a portion of these payments, a part of this payment, a partial of this note, 67 months. Now that could be 100 months, it could be 30 months, it could be whatever. I picked 67 for a reason here. My reasoning was maybe he wants to take out a certain amount of money from this note. See, notes can pay you multiple times. You flip one piece of real estate, you get paid once. You own a note, that thing can cash, you can make returns on that all kinds of ways for a longer period of time. It pays you many, many times over here. So he's going to sell 67 payments, arbitrary number. Then, assuming the person is still making payments on this after the 67th payment is received by the new investor, he'll get the final 245 payments. Okay, so put some numbers to this. He's going to receive 3 payments of $369.74. That's $1,100. He then sells to another investor 67 payments of $369.74 months. And I think I calculated this at about 8%. So are there investors who would be happy making 8% on their money right now versus crypto, versus the stock market, versus fighting people at foreclosure sales to buy real estate, right? Or sitting in cash making nothing because inflation is eating that up? I think you'd find investors who'd be really happy to go ahead and invest $20,000 backed by this property for 20 grand. And then of course he gets 90,000 on the payments on the back end.
Mr. Kevin, quick question for you. I'm getting different questions inside of our Q&A, and I sorry to interrupt, but as we move along, we'd like to be a little interactive. But the guests are asking, does the half grant go to the borrower? That's one question.
No, the grant goes directly to the note investor.
Okay.
On purpose, because imagine, you give a delinquent borrower $25,000. Now make sure you pay your lender, so they pay it directly through the servicing company that the note investor has.
Got it. And then the next question is, the program is available to homeowners only. How could the note investor qualify for the homeowner assistance fund if he or she is not the homeowner?
The note investor doesn't qualify. The borrower qualifies. You're exactly right. Whoever asked that question, the borrower qualifies. The money is paid on the borrower's behalf to the loan owner, the note investor.
Got it.
Yeah. And that's what I was saying. What we're doing is we got to reach out to those borrowers and say, hey, there's a program that can save you. It costs you nothing. Call this phone number, go to their website, apply right online. If you can't apply online, apply over the phone and get this money. And it's granted to them, so it's free money. So they qualify. And that's really what the note investors do. Like Brian, who's working on this one, he's reaching out to her. Hey, here's a program that can really save you. It can catch you up. Here's what you do. And then the state is going to then contact Brian, the note investor's servicing company, and they're going to show that delinquency. Okay. And the state's going to review that. Approved, boom, the funds go right to the servicing company that flows it right through to you. So you're correct. The borrower is the one who qualifies, not the note investor. We get paid. So the program, like most government programs, is not to enrich us. The program is to help a borrower stay in their home. That's what it's about. The byproduct is we get paid because we're buying these delinquent notes at discounts and such. So I just showed you with a small $30,000 investment what you could ultimately do if you want to long play this out. Now, again, he doesn't have to do a partial on this. He could just keep the return. He could do all of that and be just fine. But there's a lot of different flexibilities once you understand the more advanced strategies on there. In fact, and I'm going to be cautious of the time here because I probably have a lot more to cover than allotted for. One of the techniques that people can do who are looking to start with small seed capital, you can just imagine taking this strategy where you buy the whole note and sell part of it for the same amount that you bought the whole note for. And you start making money on the front end while you're stacking the back end to build up wealth as well. So there's a way with this time value of money that you can get into these by just moving your money, almost like flipping a house. Larry, did you have a question there too?
Hey, I was just going to say, just an allotment for time, because I think this is going to interest a number of people, right? Like it's a beautiful product.
Yeah.
But we are running short, right? We allotted about an hour. I want to make sure that we're respectful of everybody's time.
Absolutely.
And so in efforts of kind of summarizing and stuff here, how could, if this is something of interest to our AREAA members, to their clients and stuff, how do they dig into this more, right? So all of this sounds amazing. Yeah. What's next? What are some follow-up items and stuff that our members and stuff can take?
Yeah, absolutely. Because there's There's more passive notes that are performing and you don't have to do a thing other than collect. There's ways of getting into real estate. And this is a space that I've been teaching in really the top producers in the industry for over 25 years now, and personally been in it for over 30. So I did put together a special just for your group, because you can go to my website, you're not going to find this at all. I put it together specifically for this group as an introduction. So I have a course, it's called Real Estate Without Renters. It's about a 20-hour pure education course. So you can think of it really almost like a virtual 3-day training. I recorded it here about 2 years ago in my home studio. It's full video, full audio, and it's really hands down the best training that you'll find in the industry. I mean, I've perfected this over the years, and I've probably taught more people in the industry than anyone. So 20 hours over 15 videos. It'll be showing you calculators, showing you spreadsheets, going through all of the details through videos, and everything's explained in that. And some of the most successful people in the industry have used it. And I put it together just for a minimal price, because I figured we'd have a lot of people that are interested. But look, everybody's busy today. Everybody's looking at other things. And I wanted to put a part of what I have in my bigger program together for you. So it's just $395. You get the entire course. It's online. It's available 24/7. You can stop, start, replay. I built it where you could start video 1 through 15. You could go to the ones that you're more interested in. And I'm going to include a one-on-one session directly with me over Zoom, talking about deals and what you want to accomplish in the industry. And like I said, it's not on my website, and I know that's kind of a funky code, but I created that yesterday, and that would be the link that you would go to get that offer. And I'm sure they'll have that for you in chat or something. That's a little easier,
we actually just dropped in the
ahead.
calendar link, as well as the offer and stuff there, guys. So if this has been of interest to you, right? Like if this would like piqued your ears and you're like, oh man, that sounds better than what I'm doing, or like maybe you haven't been doing anything, right? Like this is the opportunity. And what as kind of the default committee, right? We want to share things that are working for others across the country, that are working for ourselves, that are working for our investors, that could bring some light to you guys as well. Mm-hmm. I'm just going through and seeing if there's any questions or anything that we have on here before we kind of wrap up. Any, Kevin, any closing, any closing remarks or anything that you would recommend to folks from this webinar?
Yeah, I really, once again, I think you're a complete investor when you have the real estate with the finance side. It just opens up so many more opportunities. It allows you out of situations that you may not have wanted to get in. It just adds a whole other level to that. And this course is really, it's something I have spent years perfecting and creating, and you're going to find it's the best of out there at any price, really. But I wanted to put something together that could introduce more of your investors to this concept, and from this you'll get all of the techniques. I mean, I had time to show you 2 things, in this one. So just imagine spending 20 hours with me, if you will. It'll be a lot more to go.
And through this course, do you actually teach people like where to buy these notes from? Right. So you teach them about the process and stuff. Do you give them the info of where to go and where to get that as well?
Yeah, today we have several different funnels of access to inventory. So you've got trading platforms, almost like an MLS of notes. You've got that. You've got various sources that I give people. Go here, register with them. They're active resellers of notes. And then I also teach people how to build your own relationships with companies that are creating these notes, big REO companies and things like that. So yeah, all of that is there. You're going to find inventory is not an issue in this business anymore. It's been elevated to such a status on that, but it's the right inventory in the right places that you want to go. You don't want to buy the so-called, we call them tails in the business, but that's basically the junk that nobody else wants to buy. That's what you want to avoid. And I know all the players in the business.
Gotcha. And that's kind of what your 20-hour course kind of walks through, how to kind of identify those and do those there.
Yeah, and the free 30-minute session, that's people can save that session, go through the course and say, okay, now I'm ready to talk with Kevin. Some people might get halfway through and go, I'm ready to talk with Kevin. Who knows? Somebody might be in the third video and say, all right, I got to talk to him. So I'm throwing that in there too. That free 30-minute session should be focused on your investments, what you want to accomplish in the business, and what help you need.
Beautiful, beautiful. Ernie, anything to wrap up today's session here, sir?
Hey, this was exciting. I really enjoyed this brief presentation, Kevin. And I think that all of our AREAA family, there should be a lot of benefit in this educational piece. And, investing in notes is fun because it's not like trying to find a flip or trying to find an investment. Those are few and far between. Those are needle and haystack deals. But these are always available because banks are constantly trading notes. And so I think this is a great space to learn from and to be able to invest in and get your feet wet. Try from the smaller notes first and then move up, but definitely get educated and get coached on it because there's a lot of pitfalls along the way. And you don't want to learn the hard way. It's better just to have someone coaching you along the way and then eventually get into the bigger, tougher stuff that's much more fun and profitable.
Yeah, this was absolutely great, Kevin. Like, yeah, I like from the feedback and stuff. If you look in the chat box there, like raving reviews and stuff here. So
awesome.
Looking forward to seeing how we can do some more on this, how we can bring this to some other people and stuff as well. And
Sure.
I'll definitely be following up. Like, I think there's a ton that we can do in this space. So for all of our listeners that are live, that are there, if this interests you at all, like take advantage of the offer that we have just for our AREAA members and guests and stuff there. That doesn't happen very often. And if you have any interest in seeing more like this, again, we're hosting the AREAA National Conference October 20th through October 22nd, San Diego, California. We'll drop the link and again on the Facebook live chat. It's already in the webinar chat as well. We would love to see you there. And
and let me know because this link will expire Sunday. It's set up to expire. So let me know if we need another link for something else on there. So it is set up for a limited time offer on that. So that link will expire Sunday.
All right. That sounds perfect. All right, guys. Thank you so much on behalf of AREAA National Default Committee. Thank you so much for dropping in today. Hopefully this added a ton of value. Kevin, Ernie, thank you guys for putting this together and look forward to talking to you guys soon. Have a great day, guys.
Great. Bye, everybody.